Our good friend Rick Santelli is standing by in Chicago at the CME. Rickster, what you got?
Yes, our retail sales numbers are out, Andrew. This is important. July out, much stronger than expected. Retail sales headline up 0.7%, up 0.7%. That's the second best number of the year outside of January when it was up 2.8. You strip out autos, it's improving, up 1%. Strip out autos and gas, it stays up at 1%. And if you look at the control group, which is always important, it gets inputted into higher up the food chain economic data points. It's up 1%, up 1%. That is a very strong number. Now, let's look to import prices, shall we? Headline number up 0.4%. That is double the expectations. And if you strip out petroleum, well, it moves to unchanged. So you can see where some of the pricing issues are coming from, the energy patch. And if you look at import prices year over year, they are down 4.4%, down 4.4%. That follows 6.1% that was down. Down 4.4% is the lightest year-over-year import prices going back to February when it was down 1.1%. And this is the 6 consecutive month of big minus signs in front of those numbers, and that is very important. And if we look at the export side of the equation, export prices month over month up 0.7. That is 4 times expectations. And in the rearview mirror, we see -0.9 now becomes -0.7. And up 0.7 actually is the biggest month over month increase in that since up 3%, and that was in December of last year. So that is the highest export month over month increase that we've seen for 2023. Let's take a bigger look. If you look at year over year, -7.9%. That is following -11.9%. So we see continued minus signs there. And Empire, -19%. We're expecting down 1%, so much worse than expected there. That's a lot of numbers. But if we look at the 10-year note yield to divine what we should pay attention to, it certainly seems to be concentrating on the stronger than expected retail sales as interest rates have popped up several basis points from 4.23 to its current level at 4.26. That's up 7 basis points on the day, and it underscores how today is one of the potentially most important technical days for long end maturities to see if the intraday spikes that we're looking in 10-year note yields turn out to move into the closing category, because any closing yield above 4.25 will be significant technically, and it will be equivalent to the 507.5 level in 2-year note yields that they closed at for their high yield close in March, Joe and the gang, that we have not been able to go back and close above. And that was one of the catalysts to create the long maturities rates rising. You guys can say it's the market getting more in line with the Fed. That's not what I see. What I see is we have a whole lot more data points, and we see some of the stickiness of inflation in various aspects. But this could be the last hurrah, because I still say global forces are slowing in a big way.